Welcome, ladies and gentlemen, to Lesson 4, Preparing Closing Journal Entries for Common Business Transactions, Financial Reporting. Just as the name says, what we're going to do this lesson is prepare some closing entries for common business transactions and follow that into financial reporting. So this lesson builds off Lesson 2, Lesson 3. If you haven't watched Lesson 2, Lesson 3, please do so, because the concepts build journal entries, T accounts, how those flow into balance sheet. Those kind of concepts are going to roll forward into this, and it's going to be important for you to know. So if you haven't watched Lesson 2, Lesson 3, please watch those. Alright, so period end. Alright, so period end. As you recall from Lesson 1 in the when portion of the 5 W's of financial statements, when do financial statements, or when are financial statements prepared? They're prepared at period end. That could be monthly, quarterly, annually. Whenever they're going to prepare financial statements, that last day of the our balance sheet date, or the period in which we're presenting the income statement, like September 30th, that period end, okay, at that period end we need to start booking what are called closing entries. Alright, so closing entries, what does this mean? Alright, so if you remember from Lesson 1 also, you got, or Lesson 2, you got observable external events, observable internal events, and unobservable events. Alright, so closing entries typically are these unobservable events. These events where we're incurring an expense, or not incurring an expense, we're using a benefit, or we're giving a service, but there's no cash exchanged, there's no sort of asset, there's a service or a resource, but there's no cash, right? So there's this unobservable event that's happening, and in that case, a lot of these closing entries are going to be the unobservable events. Alright, now, unobservable events, for you and me, it doesn't really affect us. We pay cash for an insurance policy, we pay rent, or when cash goes out of our bank account, see you later, that's all we think about. There's nothing else to do. We don't need to prepare a closing entry at the month end, or halfway through the period to recognize rent expense or anything like that. It's just out of our bank account and cash is gone. See you later. That's the end of the transaction for us. Well, companies are different. Companies are on an accrual basis. Remember, it's not cash basis. Accrual basis is GAAP. Cash basis is not GAAP. Alright, so cash basis would be, that's how you and I deal with it. Like, as soon as the cash goes out, we forget about it. Nothing, that expense is gone for us. But accrual basis is, well, no, have we received the benefit yet? Have we rendered a service? Those are the considerations we need to take when we're talking about closing entries. All right. So closing entries. Let's get into some concepts here about what are really closing entries. And if you'll see right here towards the bottom right of the Lesson 4 cheat sheet, you'll see types of closing adjustments. Alright, so there's deferral adjustments and accrual adjustments. Now, these concepts are very important, so I'm going to read the definition. Follow along, but you have the resources at home. You also have them in the flashcards, so you can go back and learn these concepts and definitions. Alright, deferral adjustments. Why do we record deferral adjustments? Some or all of an asset's future benefits have expired or been used up in the current period, or the company provides goods or services in the current period to satisfy an existing liability. Alright, note, the accounts in a deferral adjustment always go in opposite directions. That is, a decrease in an asset goes with an increase in expense. Opposite, a decrease in a liability goes with an increase in revenue. Alright, the effects of deferral adjustments: they reduce the carrying value of assets on the balance sheet, and they transfer the amount of the reductions to the related expense accounts. Alright, we'll get into some examples. That's the definition. Alright, definition: accrual adjustment. Why? Okay, assets and revenues are generated in the current period but haven't been recorded as of the end of the period. Or liabilities and expenses are incurred in the current period but haven't been recorded as of the end of the period. Now, the accounts and accrual adjustment always go the same direction. That is, an increase in an asset goes with an increase in a revenue, and an increase in a liability goes with an increase in an expense. Alright, so we got deferral adjustments, accrual adjustments. These are both closing adjustments, period end adjustments. Up here to the top, this concept definition we'll get into later, because that gets into sort of how we close out the trial balance and how we get to our financial statements. So temporary and permanent accounts we'll get to later. Now we're just going to start moving into some of our closing entries. So flip your cheat sheet, and we've got some period end transactions to look at. All right. So this period end happens to be September 30th for Round Belly. and we're going to go through some of their transactions, which you'll see these are common transactions. These happen in most companies, and we're going to go through them. And these, this is the key thing. Is like most of these entries you're going to see in your textbooks, you're going to see in your professor's exams. These are common things. All you need to do is change the numbers, sort of change the concept a little bit. But these kind of entries you're going to see over and over again. All right, let's get into it. A, account of the supplies indicates only $500 of supplies remain. All right. This is a closing entry, so let's stop. Or let's start the analysis of this by 1, stop. Remember, accounting is easy. 2, has a transaction occurred? Well, let's think about this. When we first started, we had $800 of supplies, and now we only have $500. So, did a transaction happen? Well, yeah, something must have happened to $300 in supplies. So, yes, a transaction happened. All right. So, what are the accounts? Well, the accounts definitely supplies, right? Supplies decrease. We had 800, now we have 500. So we know the supplies decrease. Well, what else? Probably an expense, right? This is a deferral adjustment. If we're decreasing an asset, we need to increase an expense. This is a deferral adjustment. Remember, folks, a deferral adjustment is when you take an asset that you have now and you're going to use in the future. It's a deferral, and it's deferred to the future. So now we're making this deferral adjustment where we're saying the supplies were used, let's decrease the supplies, increase the expense. All right, journal entry. A, supplies expense goes up 300. Supplies go down 300. And you say, why 300? Well, we had 800. If you look here, T account, unadjusted balance, 800. We know we want 500 because that's at the end. That's our desired balance. All right, so boom, the 300 must be the adjusting entry. Record the entry. Now, that's and you see here, that's the T account for the supplies, and then supplies expense right next to it. All right, moving on. B, 1 month of prepaid rent has been used. All right. If you recall from lesson 4, we paid 3 months' rent, $7,500 for September, October, November. Well, now this is the September end. We deferred that expense, right? This is a deferred adjustment, prepaid rent. This is something that we put the cost. Remember, in lesson 3 on the cheat sheet, it said the cost is incurred. This is asset benefit of future period. The answer was yes, so we put it as an asset. Well, we deferred that expense. And now we're recognizing that expense. Well, how much of that expense do we recognize? Well, if you look at the end of that sentence B, I go through and I say, all right, $7,500 was our prepayment. That was for 3 months. Well, we've incurred 1 month has gone by, so we've incurred that expense. So let's record 1/3 of that, $2,500. Journal entry. Journal entry is rent expense $2,500. Now we're going to reduce the asset. Remember, a deferral adjustment, you increase an expense, you decrease an asset, right? Increase expense, rent expense $2,500, decrease prepaid rent $2,500. Go to the T accounts, and you see prepaid rent, our unadjusted balance, or our carry forward balance from lesson 3 was $7,500. That's how much money we pay. That's how much cash went out the door. Now we're recognizing expense. Remember, no cash is being exchanged right now. This is accrual accounting. No cash needs to be exchanged for an adjustment. Accrual accounting, $2,500 decrease. Desired balance is 5,000. That's our ending balance. That's our ending balance. That's going to carry forward to our ledger. We'll get to that in a second. Boom. Moving on to C. 1 month of prepaid insurance has been used. All right. So let's stop. Or start. Start the analysis. Stop. Remember, accounting is easy. 1, has a transaction occurred? Well, yeah. We paid the cash. Paid $1,200, but we received the service, right? The service was exchanged. The service was our insurance. We recovered. We had insurance for that period, so we received the service. So yes, there's definitely a transaction. What are the accounts? Well, this is a deferral adjustment. Remember, deferral adjustment. We paid the cash. Does it benefit a future period? We said yes. Okay, so we recorded an asset. So asset. All right. Deferral adjustment. Asset must decrease. Debit asset, and then increase expense, right? Debit expense. What are the accounts? Well, if it's insurance, it's probably an insurance expense. Remember our charter accounts, we had insurance expense as one of the accounts, so let's put it to insurance expense. Sounds right. Insurance expense, debit. Prepaid insurance, we're going to decrease it. Remember, we used a month, we need to decrease it by the month. You'll see the calculation, $1,200 is for 12 months, $100 a month. Decrease it by 100. Our balance that's left is 1,100. You'll see here in the T account, adjusting the entry is 100 because our desired balance is 1,100. Insurance expense is 100. That's how much we use in the period. Moving on to D. 1 month of the machinery and equipment needs to be expensed as depreciation expense. Depreciation expense. What's this? We'll get into more detail about depreciation expense in a later lesson, but just understand that as we we pay for property and equipment. This is an investment. This is something we're going to use in the future, right, to make products. Well, as we make those products, we're using a portion of that asset a little bit at a time, little bit at a time. Well, depreciation expense says, well, as we use that asset little bit at a time, little bit at a time, let's recognize expense for that little bit that we use, right? So depreciation expense, we take our machinery and equipment. How much machinery and equipment did we have? We had 75,000 of it. That goes back to lesson 1 where we were buying stuff and making pure improvements, buying a docking crane, all that stuff, 75 grand. All right, we need to recognize a little bit of expense of that because that generated revenue for us. Remember, matching principle, generated revenue, recognize expense. Let's recognize a little bit of expense. How much? Well, the expense, our cost basis, it's going to last for 50 months. So we'll say we used 1 month, right? September we used 1 month, 1 over 50. That's what our expense is going to be. We go down to D. What's our interest depreciation expense? Right, this is a deferral adjustment. So we're going to need to decrease the asset credit, increase the expense debit. So depreciation expense $1,500, accumulated depreciation $1,500. Now, if that concept doesn't make sense, go to lesson, I forget what lesson it is, but there's another lesson on tangible and intangible assets. You go to that, and we get more in depth on depreciation expense and how to calculate. But for now, just know the basis is or our useful life is 50 months. We use 1 month, 1 over 50 times our cost gets us to our monthly expense. All right, moving on to E. On September 1, Roundbelly moves some cash into a certificate of deposit at the bank. The CD will pay $200 interest on December 1st. Okay, let's stop. Or start the analysis of this. Stop. I keep messing it up. I just want to stop and think about it. Okay, stop. Remember, accounting is easy. Is this a transaction? Well, let's think about this. This sounds like one of those unobservable events where we're accruing interest, or we're earning interest, or we're paying interest, right? Okay, so yeah, it sounds like a transaction because we're earning something, we're getting something, and a resource is going to be given to us, right? So that interest, so yeah, we have a transaction. Okay, what are the accounts? Well, I think, let's see here, we moved money into a certificate of deposit. The CD will pay $200 of interest on December 31st. This is on September 1st. Okay, so that's 4 months. At the end of 4 months, we're going to get $200 of interest. Okay, after 1 month, we must have earned $50 of interest. So let's recognize $50. And this, remember, this is an accrual adjustment. We're going to increase a revenue, which is a credit. And then we're going to increase an asset. Remember, opposite directions of accrual adjustment. All right, or same direction, increase. Deferral adjustments, decrease. So increase. Interest receivable, we're going to increase. We're going to be owed $50. Increase to a revenue account is a credit. Credit interest revenue, $50, right? $200 at the end of 4 months. Well, after 1 month, we must have earned 50 of it. All right, so that's the journal entry. Now look at our T account. We got interest receivable, debit, interest revenue, credit. All right, so that the T account's balanced. Now let's move on to the next. F. Roundbelly has not paid or recorded $200 interest that it owes this month on its note payable to the bank. All right, just like the one above, this sounds like one of those unobservable events, right? So let's start the analysis. First thing, stop. Remember, accounting is easy. This is easy stuff. Did a transaction occur? Yes, the interest, we're owing them something. We're receiving a service. That service is they lend us money, but we're going to have to pay them interest. So, okay, so that, yes, this is one of those unobservable events that's happening. All right, so there's definitely transactions. Okay, what are the accounts? Well,